Hello everyone, welcome to another update. My name is Chris, or you might know me as BeatTheMarketz on eToro. In this one, I wanted to touch on some of the economic reports coming out of the US this week, including durable goods, home price indices, new home sales, what the Fed Chair Jerome Powell recently said, and mortgage applications and mortgage rates. I'll quickly explain what each report is as well as provide some of the data. So I'll get straight into it. For durable goods orders, this report measures the new orders placed with domestic manufacturers for delivery of hard goods. Durable goods are items expected to last at least 3 years, and they would be things like cars or home appliances and furniture, those kinds of things. So an increase in durable goods suggests that manufacturers will be busy fulfilling these orders, which could potentially lead to job creation and economic growth as a result. In the recent report we had for May, new orders increased by 1.7% on the month over month. In terms of how that compares with previous data, it's pretty normal. Durable goods can be volatile at times, and apart from the odd shock, which I suppose some good examples would be 2014, we had a big dip in durable goods and then a sudden rise. And again in 2020, very similar thing. Obviously, because of the pandemic, we had a huge dip in durable goods orders, and then coming out of the pandemic, we had a big rise again. Now, this data seems to be fluctuating somewhere around a nominal level, and this report is more seen as positive because the expectation, or the consensus expectation, was for a decline of 1%. So for this to come in at a positive 1.7% is quite a beat. So that was a good report. Moving on to home price indices, these track changes in residential real estate prices, so they provide a measure of general housing market conditions. Rising home prices often indicate stronger consumer confidence and buying power, while falling prices can suggest the opposite. In April, the S&P Case-Shiller Home Price Index fell 1.7% on the year-over-year. That marks the biggest decline since April of 2012. However, compared to the previous month, housing prices were up 1.7%, indicating a strengthening housing market. This could suggest that while year-over-year prices have decreased, the month-over-month increases could signal a potential turnaround in the housing market. And when you look at the previous few months as well, this does appear to signal a potential turnaround. In terms of new home sales, these measure the annualized number of new single-family homes that were sold during the previous month. New home sales trigger a wide-reaching ripple effect, and that's because every new home built creates jobs, it contributes to GDP, and it creates demand as well for durables. So this is because new homeowners tend to spend on furniture, new appliances, and those kinds of things. In May, sales of new single-family houses jumped 12.2% on the month over month. Onto mortgage applications and rates. The number of mortgage applications can indicate consumer confidence and the health of the housing market. High application rates suggest that consumers are ready to buy homes and feel secure in their financial future. Conversely, low application rates might signal financial uncertainty. Mortgage rates have substantial impacts on affordability. So the higher we see interest rates go, you would generally expect people to be able to afford less in terms of property. In the week ended June 23rd, mortgage applications in the US rose 3%, but the average contract interest rate for the 30-year fixed rate mortgage edged up 2 basis points to 6.75%. The Federal Reserve Chair Jerome Powell yesterday had a meeting with the ECB where basically reiterated what we have already heard, which is that he does not see inflation reaching the 2% target anytime soon, and suggested more rate hikes are on the table. This could mean that the Federal Reserve is considering raising interest rates to keep inflation in check, which could impact borrowing costs for consumers and businesses. If we do get another 2 rate increase hikes, this could affect housing affordability, so we might see that turnaround in the housing market potentially hit stop. So in summary, these reports right now paint a positive picture, but the sustainability of some of this is in question. Rate hikes will put further pressure on the housing market, as well as big ticket price items, which can also be linked to new home sales. On the other hand, if the Fed think inflation is falling under control and maintain a pause for longer while they assess the data, this could be probably their best chance at a soft landing. And that's because the economy appears to be quite resilient. However, this may make rate cuts less likely out of fear of another bout of inflation. So that's all I have for today. I hope you found this informative, and I will continue to try and put out updates whenever I can. If you want to look at any of the data that I've discussed in this video in more detail, I will leave some sources in the video description. And other than that, I suppose I will see you in the next one.